Welcome to Markets Now. I'm Michelle Rook along with Alan Brugler Marketing, and it was a mixed day today in grain and livestock futures trade. Let's pick these apart. First of all, soybeans and meal set back here today, Alan, and how much of that was profit taking versus, I know there was a lot of Twitter talk today about China trade relations.
Well, I think in the meals case, it's mostly profit taking. We had new contract highs for the March overnight, but failed to get to the weekly chart resistance from a few weeks back. Uh, it was very overbought technically, and you just really didn't have a new story here. You've had intermittent rains in Argentina. You're not really sure what their export capacity is going to be for meal. So I think you just backed it off a little bit here, waiting for any information USDA might give us on Wednesday.
Right. Do you think USDA will be very aggressive on Argentina's production figure or not?
I agree with the basic trade premise, which is that they're going to probably drop the production a couple, 2, 3, 4 million tons, something in that nature. Be really shocked if they go to where some of the lowest private estimates are. Our take on beans is that they kind of hunker down and wait. You can give them a lot of moisture stress, a lot of heat, but when it gets to August in the U.S., if you get rain, you get some production, and they're equivalently in August there now.
Yeah. And you mentioned meal into contract highs, but cash meal, I think, in some places is over $500 already. So there's got to be some good demand there.
Well, there is some good demand. We've also had some downtime in a couple of plants that interfered with the production. We've got a shortage of corn in the Western Corn Belt, really high DDG demand in that WCB area. A lot of wet distillers being fed instead of dry because they can just haul it right out the door and feed it. Well, that's symptomatic of a feed shortage, and to the degree you can, you might modify your ration and put a little more meal in there.
Right. Corn market continues to move sideways here. That 680, 685 area just seems to be pretty big chart resistance.
Yeah, we've got a number of different indicators that are in that between 685, 694, both on the weekly and the daily charts. Again, fundamentally, export sales have been very slow. They're starting to improve, and we think they'll get a lot better here in the second and third quarters as Brazil gets out of the market from last summer's record crop. But we're so far behind that the market's just saying, well, even if we have a big quarter, we may still not make USDA's numbers. So why do we need to push the price up here?
Yeah. Do you think that we'll see an adjustment in exports by USDA and the WASDE on Wednesday or not?
They certainly could cut them another 25 to 50 million bushels based on what we know today. The real question is how much of a ramp up do we get in the second, third quarter? And they really can't put too much of a handle on that yet.
Okay, well, hopefully we'll see some more sales like Japan and Mexico, but obviously, like you said, we're behind, got to get caught up. Wheat market, we saw some intermarket spreads going on, or interclass spreads here today, but it does look like at least we have held some support areas that we've needed to hold on the charts.
Yeah, if you look at the weekly and monthly charts particularly, there's some retracement supports, there's some 100-week moving averages, there's some speed lines, there's various things, depending on which class of wheat you're looking at. The phrase I've been using is it's a great place to stop going down if the brakes work, because we've been running downhill for a while here. That doesn't mean that I'm looking for a long-term bounce, but a corrective bounce maybe on spring weather as maybe the wheat starts to green up and we find out we got a little more winter kill. Something of that nature could give us a bit of a bounce here.
Yeah. Effectively, we don't have a lot of war or risk premium on the weather side in this market, do we?
No, at this price level, there's not a lot of weather premium or risk premium. We are concerned that the Russians might ramp up an offensive here in Ukraine, trying to get some ground retaken before the West's tanks arrive. Certainly, there's a threat to the Ukraine export program in that scenario, but I don't think you get the same reaction that you did with the original invasion, even if that happens. I think the world's kind of wired around some of those supply issues that we were facing a year ago.
Right. Big down day in the cotton once again, and that market is so sensitive to China news. So that was part of the story, or what was driving it today?
I think that's a big part of the story there. Cotton has been rallying very modestly, very low slope to the line, if you will. You had some good buying interest around 72 cents on the old crop, and now we're in the mid 80s again. The weekly chart actually looks a lot more bullish in terms of uptrend. And I think that's because of the low acreage estimates that are circulating around for this coming season.
Yeah. And the cattle market, more new contract highs in live cattle futures here today. The front end of the board is getting pushed here, it looks like, by higher box beef values today. And then I heard of even some 159 cash trade in the South today. Can we keep this momentum going? Are you bullish in that respect?
Well, we're long-term bullish because of where we are in the cattle cycle. I think the mechanism is you have to have some good grass out there, then you retain the heifers, and then that really tightens up the feedlot availability of feeders, because right now we're supplementing with heifers. And at some point, you start to attract, a year and a half down the road, you get more calves going. But the point is we can get overbought. The funds are very heavily long this market, and I thought maybe we were getting ahead of the cash last week, and then we ended up with the 159, 160 trade, and the board's appropriately priced. The wild card here is whether the consumer will keep paying up for the beef here, because we do have those the recession concerns out there. The jobs report on Friday made it look like maybe we're in a little better shape than some had thought. But again, that's probably the limiting factors if we start seeing substitution.
You bet. And I'm impressed with the action in spite of all that. All right. Thanks so much for joining us, Alan Brugler. Joining us, Brugler Marketing. That's Markets Now.